Hello, everyone. My name is Mark Jarvis, and I'm a visiting professor at Manchester Metropolitan University in the Accounting, Finance and Banking Department. So welcome to a monthly series of webinars. This is the February edition, which looks at the UK economy as well as global issues. This month, we look at vaccines, bankruptcies, e-commerce, the demise of cash, and a glance at air travel and dare I say it, vacations. But first, let's start with vaccines, and as McKinsey is calling it, from a lab to jab. More than 12 billion vaccine doses have been announced by manufacturers for release in 2021. Subject, of course, to successful clinical trials. The Earth population is 7.8 billion. So coverage for a first dose seems adequate until you consider the logistics. Manufacturing is concentrated in a handful of countries. Regions without manufacturing must import the vaccine. And there's a very complicated, let's say, path for how this is going to be seen. And if I can share a slide from McKinsey, there are considerable obstacles blocking these flows, including the need for ultra-cold supply chains, lack of air cargo capacity, and of course, counterfeiting. What's needed is collective action or an unprecedented scale among manufacturers, governments, customs authorities, and others to get together and really sort this out. I think some countries, such as our very own United Kingdom, are equipped with adequate vaccine manufacturing to meet domestic needs, but not everyone is. Set against this backdrop, and moving to the global economy, is bankruptcies. And the view is that low global bankruptcies are masking perhaps an underlying malaise. Global bankruptcies declined in 2020, despite a sharp fall in world GDP. This probably unusual development largely reflects successful government interventions that disguises underlying financial stress amongst businesses. Insolvencies could still rise significantly in 21-22, and there are longer-term risks of increased, let's call it, zombification of companies and rising bad loans at banks. In a normal year, the decline in world GDP that we saw in 2020 would have prompted a surge in bankruptcies of perhaps 20% or more, with business failures peaking for 2 to 3 years after. But this has been avoided due to government support for businesses, moratoria on bankruptcy proceedings, and legal shutdowns. Still, many firms face financial distress, especially in consumer-facing service sectors. UK survey data suggests that up to 5% of firms are at severe risk of insolvency, and there is a danger that 21-22 will see a steep, if delayed, rise in business failures across economies. It's good news that in the early months of the pandemic, bankruptcies were prevalent amongst inefficient firms, but bankruptcies weren't prevalent amongst the efficient firms, perhaps a vindication of government action. However, evidence from Sweden suggests that might have changed as the crisis wore on. If bankruptcies are staved off with loan forbearance and government loan schemes, this risks displacing the problems to banks, especially those with high exposure to small and medium-sized firms, or also to the public sector balance sheet. This could, however, damage productivity growth, and it's certainly something we should watch. More broadly, and sticking to the economy, we saw an interesting January CPI jump. Eurozone core inflation increased sharply in January due to a surge in prices for both services and goods, which fits with the narrative of a pandemic-driven inflation double whammy. Domestic restrictions are increasing services prices, while a jump in demand for goods and higher container shipping costs are prompting retailers to hike their prices. But while the headline inflation numbers seem to fit that scary inflation narrative quite nicely indeed, a closer look at the details suggests that's not the story the facts are telling. Transient and more mundane forces, such as late January sales, are likely to be behind much of January's Eurozone inflation moves. Probably Eurozone and other economies' core inflation will rise from late 20s ultra low rates, but last year's global recession, I think, should keep underlying inflation pressures fairly well contained. Core inflation is unlikely to significantly exceed the rate seen prior to the pandemic anytime soon on a sustained basis, so making an imminent policy rethink by central banks very unlikely. So let's talk to what is happening, and what we are seeing is e-commerce. So do we all shop online now? Well, at least 84% of the UK does, as one of the most advanced e-commerce markets in the world. But even here, online shopping still hasn't reached everyone. And if I'll share with you a chart from Statista, while the penetration rate technically doesn't show how frequently a country's population shops online, both penetration rate and the intensity of e-commerce often go hand in hand. According to eMarketer, 27.5% of retail sales were already happening online in the UK, one of the highest rates among developed countries. E-commerce is traditionally considered to do well in densely populated and highly developed markets like the UK and Japan, where market penetration has been standing at 70% plus. Larger and more diverse markets tend to move slower. The US, where penetration was also at 70% plus, only chalked up 14.5% of retail sales to e-commerce. China, a huge e-commerce growth market, turns these expectations on their head, however. According to eMarketer, again, 44% of retail sales are already happening on the internet in the country, even though a third of the population does not yet shop online. So the big urban-rural divide might be to blame in creating an intense online shopping behavior among city dwellers, while broadband connections, let alone e-commerce, has not yet reached all of the Chinese population. Other emerging economies like Brazil and India are catching up more gradually as penetration rates for e-commerce has remained low. Southern European nations, Italy and Spain, are also exhibiting low rates of online shopping. So this, of course, leads us to ATMs. The pandemic has drastically changed the way we interact with businesses, at least temporarily, and in some ways, potentially forever. If we look at what's being called the cashless society, as you can see here in the ATM usage across the UK over the last couple of years, the lockdown-related closures of premises with an ATM will naturally be remedied once the measures are retracted, as will the lack of need for cash due to businesses such as bars and restaurants being closed. But the inevitable death of some brick and mortar businesses and the migration of commerce online will be an effect which I think will be felt for much longer. Likewise, the importance of making transactions contactless during the pandemic has led to the increased presence of card readers in establishments which previously only accepted cash. Another trend which is unlikely to be reversed once the crisis is over, I feel. Even Michael, my local big issue seller, now has a card reader. According to the UK's largest ATM network, Link is committed to protecting free access to cash for as long as consumers want it. The question is, how long will the desire for good old-fashioned bank notes, last? The impact of many consumers reducing their cash usage continues to be seen across the UK's Link network. The number of transactions fell by 12.9% between December 18 and 19, and estimates for the life expectancy of the country's ATM will, I think, have to be put on hold for now, though with the COVID-19 pandemic drastically changing the way we interact with business, it's very difficult to predict what will happen. But what will replace cash? Last month in this series of webinars, we touched on cryptocurrencies. And this week, we see Mastercard bringing crypto onto its network. Whatever your opinions on cryptocurrencies are, from a dyed-in-the-wool fanatic to an utter skeptic, the fact remains that these digital assets are becoming more important part of the payments world. We are seeing this fact play out on the Mastercard network, with people using cards to buy crypto assets, especially during Bitcoin's recent surge in values. We're also seeing users increasingly take advantage of crypto cards to access these assets and convert them to traditional currencies for spending. To be clear, this data is not of any individuals. It's anonymized and in aggregate, but the trend is unmistakable. Mastercard said they're preparing right now for the future of crypto and payments, announcing that this year, Mastercard will start supporting selected cryptocurrencies directly on their network. This is a big change that will require a lot of work. They have said that they will be very thoughtful about which assets they support, based focus on consumer protections and, of course, compliance. Their mantra is, it's about choice. Mastercard isn't here to recommend you start using cryptocurrencies, but we are here to enable customers, merchants, and business to move digital value, traditional or crypto, however they want. It's your choice, it's your money. So, a bold move, and doing this will create a lot more possibilities for shoppers and merchants, allowing them to transact an entirely new form of payment. This change may open merchants up to new customers who are already flocking to digital assets, and help sellers build loyalty with existing customers. And customers will be able to save, store, and send money in new ways. To be completely clear, not all of today's cryptocurrencies will be supported on Mastercard's networks. Stablecoins are more regulated and reliable than in the recent past, and many of the hundreds of digital assets in circulation will still need to tighten their compliance measures significantly to meet Mastercard's expectations. Mastercard expects consumers and the ecosystem as a whole will start to rally around crypto assets that offer reliability and security. It's those very same stable coins, let's call them, that they expect to bring into their network. Of course, know your customer is a key requirement, meant to stuff out that illegal activity and deception in payment networks. Also, these digital assets must follow local laws and regulations. So to reach customers, crypto assets will need to offer the stability people need in a vehicle for spending, not investment. Mastercard's already working to provide this consumer choice for cryptocurrencies. They teamed up with Wirex and BitPay last year to create crypto cards that allow people to transact using their cryptocurrencies. However, in all of these cases, cryptocurrencies still don't move through their network. Their crypto partners convert the digital assets on their end to traditional currencies and then transmit them through to the Mastercard network. Added to this, Mastercard is actively engaging with several major central banks around the world as they review plans to launch new digital currencies dubbed CBDCs to offer people a new way to pay. So lots to look out for here, and maybe that's enough of the business issues, and let's talk about vacations. Of course, right now, international travel has come to a near complete standstill due to the COVID-19 pandemic. The aviation industry suffered what it describes as the worst year in history for air travel demand. And articulating that in a Statista slide, according to IATA, the International Air Transport Association, global passenger traffic, as measured in revenue passenger kilometers, declined by nearly 66% compared to 2019, as international passenger demand dropped 75%. And domestic demand fell nearly 50% below 2019 levels. Last year was a catastrophe, IATA's Director General and CEO Alexandra Juniak said. There's no other way to describe it, he said. What recovery there was over the Northern Hemisphere summer season stalled in autumn, and the situation turned dramatically worse over the year-end holiday season as more severe travel restrictions were imposed. I think we all know that. And to make things worse, there's no real end in sight to the unprecedented crisis, with severe limitations to international travel still in place. In early February this year, IATA expects 2021 to be another down year for battered passenger airlines. The world is more locked down today than at virtually any point in the past 12 months. And passengers face a bewildering array of rapidly changing and globally uncoordinated travel restrictions. IATA predicts air travel demand to reach just 50% of 2019 levels in 2021, even if it's more optimistic scenario. If the new strains of the virus continue to take hold, things could be worse and recovery could be limited to just 13% above 2020 levels, leaving the industry with 38% of 2019 passenger demand. Of course, this directly hits tourism, and coming off the worst year in tourism history, there's little sense of optimism in the industry for 2021. Following an estimated 1.3 trillion loss in export revenue in 2020, travel restrictions are being reintroduced in 2021, as we all know, and governments are trying to curb the spread of the new dangerous variants of the coronavirus. While the brief recovery in the summer months of 2020 had fueled, I think, some hopes of a quick recovery for the tourism sector, those hopes have really been dashed by the autumn-winter wave of the pandemic. And if I can share with you one more slide. According to a recent UN WTO survey, travel experts are now very cautious in their outlook, with the majority not expecting a return to pre-pandemic levels before 2023. Much has been made of the progress in making safe international travel a possibility. The crisis is, of course, far from over. So the harmonization, coordination, and perhaps digitalization of COVID-19 travel-related risk reduction measures, including testing, tracing, vaccination certificates, etc., these are all essential foundations to promote safe travel and prepare for the recovery of tourism once conditions allow. Well, this month's finding was difficult to get some good topics to come up with. So to end on a light note, since we're all constantly on Zoom or Blue Jeans or Teams calls, a quick look at what not to say to your teams on a video call might be useful, if a little tongue-in-cheek. The pandemic might have brought office life to a shuddering halt across much of the world, but it hasn't allowed workers to breathe a sigh of relief and escape arguably one of the most annoying aspects of office culture, which is that business jargon. Even while working remotely, many office workers are still exposed to buzzwords when they touch base with the boss. And so a survey of which phrases are most hated, might be a strong word, but perhaps most annoying, has been done. Obviously, people have a lot of time to do this sort of stuff at the moment. And some phrases tend to get under people's skin more than others. And a Get Response survey polled 1,000 employees to determine the absolute worst of the worst. And the infographic on your screen now focuses on the 15 worst offenders, with the survey's respondents disliking the term synergy the most. It was followed by the seemingly innocuous teamwork and the possibly more irritating touch base. Further down, some well-known and cringe-inducing terms make an appearance, such as the next time you feel the need to reach out, and of course, let's circle back when you're ready. Despite the dislike for many of these phrases, bosses no doubt feel they are justified, and the issues may be more down to senior figures in companies using these buzzwords in a little bit too often for their employees' liking. So next time you're on a video call, think about this. Anyway, thank you very much for listening, and I do hope that very soon I'll be able to give much more positive news on these monthly webinars. Thank you.